Go
So
on.
yes, I will start now. Okay, so the topic I would be deliberating upon is transfer pricing. So transfer pricing, if we talk about it in layman's term, it is a mechanism which is put in force by different taxation jurisdiction to ensure that they get hold of their fair share of taxation. Because what happens is whenever an entity enters into a contaminated transaction with its related party, it is entered in such a structured manner that the taxation authorities don't get their fair share of taxation. So Section 92 of the Act deals with this transfer pricing regulation. So this section is specifically dedicated towards derivation of arm's length price. So when we go through the careful reading of this section, it deals with the derivation of arm's length price whenever an entity enters into a transaction with its associated enterprise. Now, on further scrutiny of this section, we realize that it deals with specifically those international transactions which has a bearing on the income and expense of the company. So a transaction which is not reflected upon on the PL statement has no relevance in this transfer pricing regime. So if we take example of issue of share capital or subscription to a share capital of any other company, we'll come to a conclusion that since it has no bearing on the income or expense of the company, it won't be taken up for this transfer pricing calculation. However, on the other hand, if we go ahead with the issue of debenture or subscription to debenture issue, that will have an impact because somebody has to pay a fixed amount of interest over a given period of time. So it's pertinent to note that how different modes of issue of share capital or maybe issue of debentures has an impact on transfer pricing calculation. And there's further section 92 subsection 3, which entails the fact that in case application of transfer pricing rule has an impact of reducing your income or increasing your expense. So this as a whole, what it does is puts the taxation authority on a back foot, in a sense that if the actual value of the transaction is 100 and on application of transfer pricing norms, we realize that the arm's length price is 70, then of course the taxation authorities won't like to go ahead with it because they will losing in terms of revenue. However, there's interesting food for thought invoked in such circumstances. Let's see this with the help of certain case law. Like in case of Instrumentarian Corporation Limited, it was ITIT Kolkata ruling. So herein the Indian entity was getting loan from its associated enterprise abroad, and since it was an interest-free loan, it wasn't booking any interest in expense on the same. So the taxation authority should be happy because this entity is not taking any benefit of expense, but that expense was the income for the associated enterprise abroad and was taxable in India at a rate of 10%. So technically they were losing out on the revenue there because this arm's length price was not taken up for consideration. So in this ruling, it was held that since this Indian entity was into losses and would not be even able to carry forward its losses, so for it was the arm's length price was considered zero, but for the associated enterprise it was taxed. So in this, we had this approach of seeing it on a separate entity basis rather than on a comprehensive basis of the group as a whole. Similarly, in the case of Fintrix Technology, it was ITIT Bangalore ruling. So, in this case, this Indian entity was paying royalty to its associated enterprise abroad. But what the TPO did was, it reduced the arm's length price to zero in case of the Indian entity and continued to tax the same in the hands of associated enterprise abroad. So we have these two rulings to conclude that at times the taxation authorities or the jurisdiction see it on a separate entity wide basis, but generally a consensus has been developed that we see it on a comprehensive basis, and of course the fact pattern of the case must match with these two cases to apply the case pattern. So when we talk about transfer pricing, we have six methods on offer to get hold of the transfer price, which is basically the fair market price. So the first amongst them is a cup method, which is controllable uncontrolled price method. So this is the easiest of them all, because in this method we get hold of a similar transaction with either within the same entity or from outside. Because in this transaction we see that the transaction must be of the similar nature, and they it's a like for like transaction. So the major problem with this method is the fact that there's lack of availability of data, because we may not always get the similar kind of transaction either within the same entity or elsewhere. So to alleviate such a situation, we do have other methods, such as one being resale price method. So this method is there to address a situation wherein an entity within India, let's say, buys or gets goods or services from outside India and sells or resells them within India or outside India. So there is a mandatory condition over here that the resale, I mean the final sale, must be made to an unrelated party, and from that resale value, we need to deduct the normal GP margin to get hold of the kind of purchase price. So that purchase price is compared to the actual price at which the goods or services have been obtained from the associated enterprise. And so that we compare them and see that if the transaction was manipulated on account of this related party transaction. However, there's one thing which needs to be noted, that this Indian entity should not do significant value addition. It should be merely acting as a reseller or a distributor. On the other hand, we have a cost plus method. Now, in this method, we have the cost data of the Indian entity available. We add the normal GP margin to get the sales value. So that sales value is compared with the actual price at which the goods have been sold to the associated enterprise abroad. Now, in this case, the Indian entity can be a manufacturer, and it can do significant value addition. So we have cost plus method and resale price method are kind of anti of each other and kind of move in reverse gear when compared to each other. And of course, they are there to address different scenarios altogether. Now, the problem with cost plus method and resale price method was the fact that they used to play with the gross profit margin, and gross profit margin at times fails to take the impact of functional difference. Now, functional difference in the sense that one company may be operating in economies of scale, another company, maybe taking good amount of risk, so it may be hoping for good amount of return as well. So transactional net margin removes those complications by bringing in the net profit, as an adequate measure. So what we do over here is we get hold of a PLI, which is a profit level indicator. Let's say an entity is selling to its associated enterprise, so its sales side is contaminated. So we get hold of the gross margin, rather the operating margin, and divided by the COGS. So COGS is the debit side, which is not contaminated since it's not purchasing anything from its associated enterprise. So we get a profit level indicator, and we'll just multiply it with the COGS to get a value, and that value is compared with the actual transactional value at which the transaction has been undertaken with the associated enterprise. So we get an idea if the transaction has been manipulated on account of related party transaction. And the last among the methods that we have on offer is the profit split method. Now, this method, what we do is, there are different associated enterprise which come together to contribute, maybe in terms of cost sharing arrangement or giving in their intangible assets. And the profit which is derived from the undertaking which these guys are doing it's segregated. Now, the problem with this method is the availability of data. One can structure or make documents in such a manner that the jurisdiction which has least amount of tax gets the maximum profit. So at times the revenue authorities don't accept this transaction. Now, there is one important concept on offer over here, which is the RAIN concept. So the act mandates that you need to choose only one method to derive your arm's length price. So you can have 6 or more than 6 arm's length price derived by application of a single method. Now, in case it's more than 6, we need to apply the range concept. So range concept is nothing but a statistical measure to get hold of the median. Since median is more suggestive of the data set rather than mean, because mean at times get violated by extreme values. And in case, of course, the data set is less than 6, we can go ahead with the mean of the same. Now, there is one important concept over here, which is functions, asset, and risk analysis. So this comes into picture when we need to choose the kind of method we apply for the derivation of arm's length price, the kind of related party or comparables which we are looking into, and the tested party as well, because a good amount of analysis goes into it to determine the kind of function which is undertaken by the tested party, and the functions which are taken care of by the associate enterprise, and as well as the comparable. Also, the risk factor is also plays an important role. Somebody who operates in economies of scale, or somebody who has higher gearing ratio, will tend to have a good amount of profit, since it's taking a good amount of risk as well. Now, associated enterprises, I will briefly touch upon it. So this is basically the related party with whom the transaction has been undertaken. The Act has given certain parameters to determine who the associated enterprise is. So someone who controls over 26% of our shareholding, maybe directly or indirectly, or somebody who has control over our board of director, or determines who our managerial person would be, somebody on whom we are dependent to, for licenses or patent, or somebody from whom we are getting hold of 90% of our raw material, and somebody who determines our sale value, or the quantity which will be sold, and has a adequate control on the same, would fall under the parameter of associated enterprise. Now, most appropriate method out of the six on offer would be choose, taking into account different factors: the nature of the industry, the year in which this thing has to be applied, and availability of data will also be taken into account, and also different ruling taken by different tax jurisdiction will also be taken into account to choose the most appropriate method, so that it passes through the process. Now, I'll just briefly touch upon different transactions. So let's say there is a case of interest on loan. Now, it's a normal consensus within the industry, like when an Indian entity takes a loan from outside India, so we use the LIBOR rate to benchmark and get hold of the transfer price. But in case the Indian entity has issued loan to its overseas associated enterprise, we of course use the SBI rate for the purpose of benchmarking. So in case of issue of share capital, as was discussed earlier, since it has no bearing on the income statement of the company, we don't take it up. But let's say somebody happens to issue or subscribe to a share capital which is above or below the fair market price. So there is a hidden loan or a prepaid thing within it. So we do need to do a certain amount of adjustment into it to get hold of the accurate nature of the transaction. Now, in case of corporate guarantee, in case the guarantee has been taken, we do have a separate safe harbor rule within the transfer pricing regime to take care of that. And otherwise, we try to map it between 3 to 5% depending on the risk tolerance level. Now, in case the guarantee has been given, so we have a separate Ind AS accounting as per Ind AS 109, which mandates that we need to account for the guarantee given as an asset and book a corresponding income on it. And this income would be booked at an interest, which would obviously be a fair market rate, which is of course again taken care by Ind AS 109. So the Ind AS itself takes care of the fair market valuation. Now, I'll just say that in case of tested party, there is a general misconception that the tested party always happens to be the assessee. No, the act doesn't mention this part anywhere, that the tested party always has to be an assessee. The tested party should be the party on which the transfer pricing norms would be applied, and it should be an entity where the data would be readily available and the transfer pricing rules and method could be easily applied. So it can even be the associated enterprise which is situated outside of India, provided we have the data readily available and the transfer pricing norms could be easily applied on the same. Now, towards the end, I'll briefly touch upon the Vodafone tax saga, which was a matter of concern over the last few years. So in this case, what happened was Hutchison Telecom International and its subsidiary CGP Limited had a substantial share in Vodafone, rather the Hutchison SR Limited in India. So these two companies, Hutchison Telecom International Limited and CGP Limited, were based in Cayman Island. And one fine day, they decided to sell off their shareholding to a Dutch company, which was Vodafone. Now, these shares were not held by any Indian company. And since this transaction was undertaken, they did not pay any tax to the Indian tax authorities. But the tax authorities came into picture and said that we do need our fair share of tax revenue. So, I mean, Vodafone approached the Bombay High Court. They got a ruling against them, and then they approached the Supreme Court. They did get a ruling in their favor, but the income tax authorities came up with a retrospective amendment by adding a kind of explanation to Section 214, which was capital asset, mentioning that you know whenever you transfer a capital asset, in case you transfer the right of management or control, it would be a capital asset, which would, and you will be liable to pay tax in India. So with this retrospective amendment, since they had sold more than 50% of the shareholding, so also they had transferred the right of management. So, with this effect, they tried to derive revenue from the Vodafone, but they did approach the International Court of Justice and got the ruling in their favor. And we are yet to see how things will move in the future. Now, there's one thing I will conclude. Since inception of the transfer pricing in the year 2000, the act has gone through numerous changes over the period. Since this world happens to be a global village, no country can survive unless it enters into trade and commerce with its neighboring countries. So the act has updated itself with the time to make sure that it is able to surpass different challenges. And we have seen different amendments being made from time to time to make sure the act is updated, and the same will happen in due course. And transfer pricing does